Something uneasy is settling into the background of the global economy, and it is not coming from a single data point or headline. It is coming from a question that markets, allies, and voters are asking quietly rather than publicly. If Donald Trump returns to power, is the economic direction he signals a strategy designed to extract leverage? Or is it a form of recklessness that risks damaging the system it relies on? This anxiety is rarely stated directly. Instead, it shows up in hedging behavior, cautious language from diplomats, and a subtle widening of risk premiums. People are not panicking, but they are adjusting. That distinction matters. Panic is loud. Adjustment is what happens when experienced actors sense danger early and move before everyone else does. At the center of this unease is what many analysts privately describe as a madman strategy, not as an insult and not as a claim of irrationality, but as a theory of power. The idea is simple. If your opponent believes you are willing to tolerate economic pain, instability, or disruption, they are more likely to concede to avoid worse outcomes. Unpredictability becomes leverage. Volatility becomes a message. The problem is that this approach blurs an important line. There is a difference between controlled risk and uncontrolled self-harm. There is a difference between signaling toughness and actually weakening the foundations of your own economy. The quiet debate now underway is about where that line sits in 2026. What makes this moment different is not Trump alone. It is the condition of the system he would be pressuring. High debt, tight financial conditions, fragile supply chains, and sensitive inflation mean the margin for error is thinner than before. The question being whispered is whether pressure works or whether the system absorbs the damage. The idea commonly called the madman strategy did not originate with Donald Trump, and it is often misunderstood. At its core, it is not about chaos, incompetence, or emotional instability. It is about deliberately cultivating uncertainty so that opponents cannot reliably predict how far you are willing to go. When uncertainty rises, bargaining power shifts. The modern reference point is Richard Nixon. During the Cold War, Nixon believed that if adversaries thought he might act irrationally or escalate beyond expected limits, they would be more cautious in challenging American interests. This perception was meant to create restraint without constant use of force. Fear, in this framework, substitutes for action. What this strategy is not, however, is random behavior. It still requires internal discipline, clear red lines, and a strong system capable of absorbing shocks. The unpredictability is selective, not universal. The goal is to frighten the other side, not destabilize your own foundations. When those distinctions collapse, the strategy stops being coercive and becomes destructive. Trump embraces this approach more openly and more aggressively than previous presidents. He does not treat unpredictability as a subtle signal. He uses it as a visible feature. Tariffs announced abruptly, alliances questioned publicly, institutions pressured openly. The message is not hidden, it is broadcast. There are reasons for this difference. Trump operates in a media environment that rewards spectacle and conflict. He also distrusts bureaucratic constraint and believes conventional predictability weakens American leverage. In his view, if markets, allies, and rivals are comfortable, they are exploiting you. Discomfort becomes proof of effectiveness. This is where myth and reality diverge. The madman strategy can extract concessions when the underlying system is strong and opponents fear escalation more than instability. It fails when the system itself becomes the victim of uncertainty. The open question now is whether today's American economy can still play that role. This distinction matters because many critics attack a caricature rather than the strategy itself. They assume unpredictability equals incompetence or that volatility signals loss of control. In reality, the approach is transactional. It assumes actors are rational but risk averse and that fear of worst outcomes shapes decisions. The danger is not the theory, the danger is miscalculation. If rivals stop believing unpredictability is deliberate and start believing it reflects genuine instability, leverage collapses, confidence drains, capital retreats, allies hedge. What was meant to intimidate others begins to corrode trust at home. That transition can happen quietly and faster than expected, especially in complex economic systems where confidence is the binding agent holding everything together. This dynamic is why execution matters more than posture, and why timing, institutional strength, and restraint determine whether pressure succeeds or implodes under real-world conditions today. When people talk about Trump's economic posture, they often reduce it to one word: tariffs. That is a mistake. Tariffs are only one instrument in a larger toolkit, and the real effect comes from how these tools stack together and reinforce one another. The strategy is not a single punch. It is cumulative pressure applied across trade, finance, regulation, and institutional signaling. Start with tariffs because they are the most visible. Tariffs are not just a tax on imports. In practice, they are a negotiating weapon, a domestic political signal, and a way to reroute supply chains by force rather than incentives. The immediate impact is higher costs somewhere in the system. Companies either absorb them through margins, pass them to consumers, or shift sourcing. None of those outcomes are free. The deeper impact is uncertainty. If tariff levels can change quickly, long-term investment decisions become harder and capital becomes cautious. Then there is currency pressure, usually discussed as calls for a weaker dollar or accusations of manipulation by trading partners. The aim is competitiveness, but the method matters. When a president treats exchange rates as a lever to pull publicly, markets do not only hear a policy preference, they hear possible intervention, possible retaliation, and possible instability in the world's reserve currency. Even if nothing changes mechanically, the conversation itself alters expectations, and expectations are what move money. Trade threats are the connective tissue. They do not need to be executed to be costly. If companies believe a market could be closed, a treaty could be revised, or a partner could be punished, they hedge by holding inventory, diversifying suppliers, delaying expansion, or shifting production. Each hedge is rational on its own. Taken together, hedging becomes a drag on growth. Sanctions and extraterritorial enforcement are another tool Trump has shown comfort using. The logic is simple. If the U.S. controls key financial rails, it can impose costs far beyond its borders. But sanctions also create incentives for workarounds. Each aggressive use of financial power motivates rivals to build alternatives and motivates neutral actors to reduce exposure. That process is slow, but it compounds. Reshoring and industrial policy are often framed as positive, but they also contain coercive elements when paired with threats. Bringing manufacturing home can strengthen resilience, yet if it is driven by abrupt restrictions and punitive measures, the transition becomes disruptive. Costs rise before capacity is built. Shortages appear in unexpected places. And because supply chains are complex, the damage rarely stays contained to the targeted sector. Finally, there is executive leverage over institutions. Even without rewriting laws, a president can reshape expectations through appointments, public pressure, and aggressive use of discretionary authority. Markets pay close attention to signals about the independence of central banks, the stability of regulatory frameworks, and the predictability of enforcement. When institutions appear politicized, investors start pricing political risk the way they would in emerging markets, not because the U.S. is fragile, but because uncertainty is infectious. Here is the key point. None of these weapons operates in isolation. Tariffs push inflation risk. Inflation risk pushes interest rate uncertainty. Rate uncertainty pushes debt servicing pressure. Debt pressure amplifies sensitivity to shocks. Sanctions trigger retaliation or workaround systems. Workarounds weaken the long-term reach of U.S. tools. And through it all, the deliberate unpredictability that makes these tools scary also makes the domestic system harder to manage. Markets can tolerate bad news. What they struggle with is unstable rules. When unpredictability is a tactic, systemic risk becomes the side effect. In 2026, the central question is whether the leverage gained abroad is worth the volatility absorbed at home. On the surface, the U.S. economy can look tougher than the rest of the world. Growth has been more resilient than expected. The labor market has often held up. Equity markets can recover quickly. Those headlines create a sense that America can absorb almost anything. But beneath that surface are fault lines that make 2026 a very different environment from the one Trump operated in during his first term. This is where the phrase economic suicide stops being a slogan and becomes a conditional possibility, not because collapse is inevitable, but because the system is more exposed to policy shocks than people want to admit. Start with debt servicing. The United States can run large deficits for a long time, but the cost of doing so depends on interest rates. When rates were near zero, debt felt abstract. With higher rates, debt becomes a cash flow problem. Every refinancing cycle pulls more federal revenue toward interest payments rather than programs, investment, or tax flexibility. That reduces room to maneuver during crises. It also makes markets more sensitive to signs of fiscal indiscipline because rising borrowing costs can feed on themselves. You do not need a default to create a problem. You only need a rising share of national resources being redirected toward servicing yesterday's obligations. That links directly to interest rate risk. Even if the Federal Reserve tries to remain independent, the economy is now more rate sensitive. Mortgages, consumer credit, corporate borrowing, and government financing all react. The issue is not only the level of rates, but the volatility of expectations. If markets sense a political push to pressure the Fed or sudden trade measures that reignite inflation, rates can move quickly. In a highly levered economy, fast moves matter more than the destination. Many failures happen not because rates are high, but because they change faster than balance sheets can adjust. Then there is dollar dominance, often treated as permanent. The dollar's reserve role gives the U.S. enormous advantages: lower borrowing costs, deep capital markets, and the ability to use financial sanctions as power. But dominance is not a switch that flips overnight. It erodes at the margin through incentives and behavior. If America uses financial tools aggressively and unpredictably, more countries and firms look for ways to reduce exposure. Most will not abandon the dollar, but they will diversify settlement, build alternative payment channels, and reduce reliance where they can. The danger is not replacement. The danger is gradual friction that makes U.S. financial power slightly less effective and U.S. financing slightly more expensive over time. Supply chains are another weak point, not because they are broken, but because they are optimized for cost, not political turbulence. Tariffs, export controls, and sudden restrictions do not only hit imports. They ripple through components, inventory, logistics, and planning. Reshoring sounds simple until you run into bottlenecks in skilled labor, permitting, capital costs, and time. In the transition, you often pay more for less. If policy shocks come faster than supply chains can adapt, the result is higher prices, lower availability, and lower productivity. That is inflationary pressure without the comfort of real growth. Now look at consumers. The U.S. economy is heavily consumption-driven, and consumption is psychologically fragile. Inflation sensitivity is higher now because people have lived through a period where prices rose faster than wages for many households. Even if inflation prints improve, the memory remains. When households expect instability, they change behavior. They delay purchases, trade down, or rely more on credit. That makes the system more vulnerable to another spike in essentials like energy, food, and shelter. You can call it sentiment, but sentiment drives spending, and spending drives the economy. Corporate leverage is the quiet amplifier. Many firms carry significant debt that was manageable when borrowing was cheap. Higher rates expose weak business models, especially in sectors dependent on refinancing. Add a policy environment where tariffs, trade restrictions, or geopolitical shocks can hit revenue, and you create a two-sided squeeze. Costs rise while demand weakens. That is when layoffs accelerate and the labor market turns, often suddenly. Companies do not need to fail in large numbers to create a downturn. They only need to stop hiring and start cutting at the same time. Put these together, and the picture is clearer. The U.S. economy is not weak, but it is less forgiving. It can absorb shocks, but the price of absorbing them is higher and the margin for error is thinner. In that context, a strategy built on deliberate unpredictability can backfire. If the point is to scare rivals into concessions, you need a stable domestic base. When the base is exposed to debt costs, rate volatility, supply chain friction, and inflation sensitivity, the risk is that pressure abroad translates into strain at home. That is the boundary between hard bargaining and self-inflicted damage, and in 2026, that boundary is closer than most headlines suggest. If Trump signals a return to high-pressure economic tactics in 2026, the response will not arrive as a single dramatic moment. It will arrive as a sequence of rational adjustments by different actors, each protecting their own interests. The key is that these responses will interact. What looks like cautious hedging in one place can amplify volatility elsewhere. And because modern markets run on expectations, confidence erosion matters more than any one event. Start with markets. Markets do not wait for policy to be executed. They price direction, tone, and probability. The first move is usually not panic selling. It is rotation and hedging. Investors shift toward assets that perform better under uncertainty and away from areas most exposed to trade disruption, higher inflation risk, or regulatory unpredictability. Borrowing costs can rise even without an official rate hike because lenders demand a higher premium for uncertainty. Currency markets respond to perceived instability and policy coordination. The result is not necessarily a crash, but a persistent risk tax embedded in valuations, financing, and capital spending. Then comes corporate behavior, which is often more important than investor sentiment. Large firms with global supply chains and thin margins do not make heroic bets. They protect continuity. They diversify suppliers, build buffers, and slow expansion until rules stabilize. That means more inventory, higher operating costs, and more cautious hiring. It looks prudent at the company level, but macroeconomically, it reduces dynamism. This is a second-order effect many commentators miss. The economy slows not because a tariff exists, but because uncertainty forces everyone to operate defensively. Allies respond differently. They rarely confront Washington publicly unless forced. Their first instinct is quiet distancing. They hedge in procurement, diversify trade links, and reduce dependence on U.S. political decisions where they can. Europe, Japan, South Korea, Canada, Mexico, and other partners will try to keep relationships functional, but they will also seek insurance. That can mean more intra-regional trade agreements, more supply chain redundancy, and more strategic autonomy language that is diplomatic on the surface but real in budget and planning. The practical effect is a less cohesive coalition environment, which reduces the leverage the U.S. gains from acting in concert with partners. Rivals adapt asymmetrically. They will not try to mirror U.S. power tool for tool. They will target weaknesses and costs. China, in particular, is likely to respond by accelerating workarounds rather than chasing direct confrontation. That could include rerouting trade through intermediaries, expanding non-dollar settlement options, increasing domestic substitution, and using selective retaliation that hits politically sensitive sectors without triggering total rupture. The objective is not to win an argument. It is to raise the domestic political cost of U.S. pressure while maintaining flexibility. The more predictable Trump's escalation triggers become, the more rivals can design responses to exploit those triggers. Other states will watch and learn. Middle powers and commodity producers pay close attention to how sanctions, tariffs, and enforcement are applied. If they perceive U.S. policy as more transactional and less rule-based, they adjust by diversifying relationships earlier. This matters because it reshapes the background architecture of trade and finance. It is not a headline event, but it changes the default choices companies and governments make over time. The most dangerous part is feedback. Markets hedge, firms slow investment, allies hedge, rivals adapt. Then the domestic economy starts showing softer data. At that point, political incentives can push toward even more aggressive moves to demonstrate strength because backing down looks like weakness. That creates a loop where policy volatility increases just as the system becomes more sensitive to volatility. Even if the intent is leverage, the outcome can be self-reinforcing instability. This is why the second-order effects are the real story. A tariff can be negotiated away, a threatened sanction can be softened, but confidence, once dented, is slower to rebuild. If investors, businesses, and governments start believing the rules can change rapidly and unpredictably, they do not wait for clarification. They build their own insurance. They reduce exposure. They keep options open. And when enough major actors do that at once, the economy pays a compounding cost through higher financing premiums, slower investment, and a more fragile coalition landscape. So the likely response in 2026 is not a single crisis, but a gradual tightening of conditions. That tightening is the signal. It tells you that the world is adjusting to the possibility that American policy will be more volatile, more coercive, and less predictable. The danger is not that the U.S. loses power overnight. The danger is that the price of using that power rises, and the domestic economy ends up absorbing more of the cost than the strategy originally assumed. There are only a few plausible ways this plays out, and none of them involve simple victory or clean defeat. The future path of the U.S. economy depends less on intentions than on discipline, timing, and the ability to stop when leverage has been achieved. The first path is controlled chaos that extracts concessions. In this scenario, pressure is applied deliberately and selectively. Tariffs, threats, and financial tools are used to force renegotiation, but escalation is managed.